Welcome to another episode of the Real Estate Confidant. I'm your host, Mike Razor, here in New York City. Ladies and gentlemen, I just hopped on to the Anchor podcast as well, on iTunes, Google Play, Spotify, etc., etc. This is going to be a quick show, ladies and gentlemen. It's kind of like a quick tip, on what the things that you need to get a mortgage loan. Things that you need to get a mortgage loan, ladies and gentlemen. All right. So let's go ahead and go into this really quickly. So first things first, the last episode that I put up was in regard to the 2-year requirements for work history to get a loan, to be approved for a loan. So we debunked that whole situation, brand new stuff. All right. So if you haven't listened, go ahead to the last podcast. This way you can go ahead and listen in on that. Okay. So today's quick podcast this quick podcast is going to be about FHA and conventional requirements for approval of the loan. This is something that some of you guys need to know. Some of you guys don't know and are trying to figure this out. And I always say, speak to multiple mortgage bankers, okay? Speak to multiple mortgage professionals to see what it is that they require, because some don't require any credit score at all, and some do. The minimum requirement for FHA is 580, and the minimum requirement for a conventional loan is, I believe, 680, 620 to 640. So let me go ahead and give this a rundown real quick. So if you go to the Lending Tree's website, lendingtree.com, the article that I'm reading from is up there for you. The article title is Minimum Mortgage Requirements for 2019. This should be able to help some of you guys out on your journey in purchasing your first home, your first property, the investment, and so on and so forth. Okay, ladies and gentlemen. So let me go ahead and put the link inside the YouTube really quickly so you guys will have it. And let's go ahead and move on. Like I said, this is supposed to be quick, and it should be quick. All right, so let's see, ladies and gentlemen. So these are the current minimum requirements for an FHA approved mortgage. And those individuals who are on the podcast, the website, just to let you know, is lendingtree.com /home/mortgage /minimum-mortgage requirements which means that if you want to get the link a whole lot faster, you could just go to Lake Dawson TV on YouTube, and the video will have the link up there on the live video. Okay, so let's go ahead and move on. So these are the current minimum requirements for an FHA approved mortgage in 2019. So the down payment requirement is this. There's a minimum 3.5% down payment with a credit score of at least 580. A 10% down payment is allowed with the credit score between 500 and 579. Look at that, ladies and gentlemen. The down payment can come from your own bank account, a gift from a relative, and even local down payment assistance program. Now, a gift from a relative, they're referring to immediate relatives and not distant relatives. Okay, so I got caught up in that situation once before. They're referring to mom, pop, sister, brother, that kind of thing. Okay. All right, let's go ahead and move on. Debt to income ratio. The Department of Housing and Urban Development, HUD, sets the debt to income ratio for FHA mortgages program. Currently, the front end ratio is 31% and the back end is 43%. Front end ratio considers only housing related costs, such as the monthly mortgage payment, property taxes, and insurance. Back end ratio looks at all monthly debt, including housing costs, car loans, credit card payments, and any other recurring debt. Now, just for you to be, to be clear, you go to biggerpockets.com/calc, and you could get those calculations. Okay. Biggerpockets.com/calc. I always talk about it. This way you'll get the calculator to be able to calculate those numbers, ladies and gentlemen. All right. So, residence. The home must be your primary residence for at least the first year. This includes whether you are buying a single family home or a 2 to 4 unit property, right? Now, with this situation, if there's an emergency of some sort, because I don't want you guys to get, emotional. Well, what if something happens or whatever? If this is, if an emergency comes up, if for whatever reason the neighborhood is terrible and you need to move out, you have the right to move out. Okay. But what they're saying is, it is expected of you to live in the home for more than 1 year, or at least 1 year. Okay. So, this way, now that you know, especially if you guys are planning on renting the property out, et cetera, you live in one unit, rent the other unit out, whatever, however you guys do it, okay? So, employment. You must have steady income and proof of employment for the last 2 years with explanations for any frequent changes in employment. This is what we discussed last podcast and last video, ladies and gentlemen. So let's be clear. It's not saying that you can't go to another company. It's not saying that if you leave your company and get hired somewhere else, that it's not, that you won't be eligible. It's not saying that, right? So what they just want to know is what was the purpose for, actually it says with explanations for any frequent changes in employment. So if you go to another company once, that's not frequent. If it's when you're in a company for a year or 6 months, then you go to another company for 6 months and then another one for a year. That's what they're referring to. Okay. Especially the independent business owners who, juggle, with income from time to time. These are the things that these people are referring to. All right. Mortgage insurance. Right, is required regardless of down payment amount. You pay 2 mortgage insurance premiums on an FHA loan. The upfront mortgage insurance premium and the monthly mortgage insurance, which you pay every month for the life of the loan. The upfront mortgage insurance premium is 1.75% of the total balance due at closing and is usually financed into your loan. If you make the 3.5% down, you'll pay an annual fee of 0.85% of the total loan amount. This will be divided by 12 and is part of your monthly payment for as long as you have the FHA loan. So let me clear this up, okay? Private mortgage insurance, because this just says mortgage insurance. This is the bull that I'm talking about, okay? So let's be clear. PMI, right? You have your own mortgage insurance that you have, but this PMI is because you have 3.5% down, minimum down payment. If you put 20% down and your rate, your what's it called? Debt to income ratio, your equity ratio is above 78%, or at 78%, then you don't have to pay private mortgage insurance. Okay, so this is a little confusing, this part, for individuals who don't know. But if you go 2 podcasts before this one, I talk about private mortgage insurance and the requirements under private mortgage insurance. Okay, this is what trips people up and is confusing. Okay, so this is under, and I guess they did it that way because it's under FHA and it's 3.5%, but it needs to be cleared up. Okay. So let's move on real quick. Conventional loan requirements. Okay. Hopefully you guys have a pen and paper. You guys are writing this stuff down, et cetera, et cetera. Okay. Conventional loan requirements. A conventional 30-year or 15-year mortgage has slightly stricter requirements than an FHA loan, but it does have some flexibilities and longer-term benefits. All right. Down payment. Some lenders may allow you to make a down payment of as little as 3% and qualify for a conventional mortgage. Although mortgage insurance will be required, some of these low down payment programs may have income limits, so be sure to check the address of the properties with your loan officer to see if it has restrictions. Mortgage insurance. With a conventional mortgage, you won't need to carry and pay for private mortgage insurance. Oh, see, now they do it. Look at this. If you can make a down payment of at least 20% on the property, if you put down a low amount, however, expect to pay around 0.15% to 1.95% of the loan balance in PMI fees each year. One other benefit of conventional loans is once you've paid down the principal to 78%, the original value of the property, the lender must stop charging your mortgage insurance as long as your payments are on time. With an FHA loan, if you made a minimum down payment, the only way to get rid of your monthly mortgage insurance is to refinance your loan. Now, for clarification, you're refinancing the loan. You can refinance your loan within 6 months to a year, number one. Number two, you're refinancing the loan because the equity in the property is over that 78% mark. So say, for example, you purchase a property wholesale. You then decide to move in under FHA. You get a renovation loan. You do the renovations and all of that good stuff. You get it reappraised. And on top of that, you are over the 78% mark for the principal balance, right? So now you go to the bank. You want to refinance. They look at the numbers and see that the appraised value is this amount, is way higher than the 78%, and boom. Now your PMI is gone, you refinance, and you have a lower monthly mortgage payment, and you could do a HELOC because you did the renovations, or you could just take the equity out of the property and purchase a newer property. Okay, I'm going off tangent. Let me keep going. So credit score. The minimum score for a conventional mortgage is 620. Although some lenders may require a minimum score of 640, keep in mind that higher credit scores or better credit scores will entitle you to a more favorable interest rate and a lower monthly mortgage insurance payment on the mortgage. That's obvious, ladies and gentlemen. If you have a better credit score, then basically you have a better chance of getting a lower rate. I mean, all the way down to 2 or 1% interest rate on your mortgage, which is amazing. Okay. So let's be clear on that. All right. Debt to income ratio. As of the end of 2018, conventional lenders allow debt to income ratios up to 50% in select cases. One caveat: for anyone with debt ratios over 45%. Many mortgage companies are now requiring a minimum credit score of 700 or higher for a higher debt ratio. Okay, ladies and gentlemen. So that should be clear enough for you. There was something else that I wanted to say. Boop, boop, boop. If it comes back to me, I'll let you know. Oh, yes, the debt to income ratio. One thing I want to tell you guys, if you're purchasing multi-family houses, and when you do the numbers under biggerpockets.com/calc, and you send that information into the mortgage bankers, they include the income from the other units that you have. So if the average rent in that neighborhood for your 2-bedroom, 2-bath under those 3 units that you have are $1,000 each, they'll include $3,000 a month times 12 months into your income that you already make for the debt to income ratio option. Okay, so let me move on. VA loan requirements. All right, a mortgage through the Veterans Affairs Department benefits active duty military personnel, et cetera, et cetera. Okay, to qualify for a VA mortgage, you'll also need a VA loan certificate of eligibility, the COE, which verifies the applicant meets military service requirements to be eligible for a VA mortgage. Specific documents and identification are required. Military personnel and veterans can apply online through a lender or by mail after completing the form. A down payment, there's no down payment required for VA loans. Mortgage insurance. VA loans don't come with PMI fees. However, there is a funding fee associated, which is charged at closing and is usually financed on top of the loan amount. The amount of the funding fee will depend on whether the veteran is using eligibility for the first time. If the applicant has a disability related to his or her military service, the funding fee may be waived. Credit scores. VA loans do not have a minimum credit score requirement, but most lenders that fund VA loans have a minimum cutoff of 620. The VA loan program only requires the lender review the entire loan profile to make sure the veteran has the ability to repay the loan. All right. Excuse me. I'm sorry. Give me 1 second. All right. I know we're moving through this thing a little fast, but trust me, you'll be all right, okay? Hopefully you guys are taking this information down. All right, to qualify for a USDA mortgage, oh, excuse me, I went way past where I was going. All right, let me finish. The amount of the funding fee will depend on whether the veteran is using eligibility for the first time. If the applicant has a disability related to his or her military service, the funding fee may be waived. Credit scores. Oh, I did credit scores already. 620. Cutoff 620, no minimum credit score requirements. Income. There's no minimum income threshold to meet, although applicants must still be able to show proof of steady income. Debt-to-income ratio. To qualify for a VA loan, it is suggested that your debt-to-income ratio is not higher than the 41%. Higher debt ratios can be approved since VA loans, VA lenders also look at the veteran's residual income, which is calculated based on after-tax income minus expenses and a monthly maintenance calculation based on the size of the house and the numbers of people in the veteran's family. All right, USDA guaranteed loan requirements. Now, this is an amazing opportunity for those who live in rural neighborhoods, okay, rural counties. The U.S. Department of Agriculture offers a mortgage program to provide low to moderate income families a chance to own their own home in designated rural areas. Applicants can build, rehabilitate, improve, or relocate a dwelling in an eligible rural area. These rural designations are determined based on population using 2010 U.S. Census data. The USDA Guaranteed Loan Program backs 90% of the loan amount, which allows USDA-approved lenders to consider borrowers who may not qualify for conventional home loans. USDA mortgage loans require a minimum credit score of 640 for automatic approval, provided other requirements are also met. However, home buyers with lower credit scores can still be considered for a manual underwritten loan. All right, to qualify, you must also meet the special eligibility requirements in your state. First, use the USDA's online tool to determine whether the property you're considering is within a designated rural area. To use this tool, you'll need to enter the street address, city, state where the house is located. This confirms whether the home you wish to buy is within one of the USDA designated rural areas, okay? The home buyer must also meet these basic requirements to qualify for USDA mortgage. Agrees to personally occupy the dwelling as their primary residence. The property cannot be used as a second home or rented out. Must be a U.S. citizen, non-citizen, national, or qualified alien. Can legally incur the loan obligation. This simply means the buyer has not been declared incompetent and has the capacity to understand the debt obligation and enter into legally binding contracts. Has not been suspended or banned from participating in federal programs, shows a willingness to meet credit obligations on time, purchase property that satisfies all USDA program criteria, including location within a rural designated area. Okay, debt to income ratio. The standard DTI ratio for the USDA home loan are 29% to 41% of the applicant's gross monthly income. The maximum allowable debt to income on a USDA loan is 32%/44% of the gross monthly income if all applicants on the loan have a credit score of at least 680. Okay. All right. Let's see what else. Woo! Let's go down to the next. Home ready, home possible loan requirements. Okay. And this is one thing that we discussed in the last episode, but let me go ahead and go on real quick. All right. Give me 1 second. All right. Home Ready, the government-sponsored agency Fannie Mae offers the Home Ready mortgage program. You can go to the website homepath.com as well. In income, these programs are designed to help prospective home buyers who have moderate to low income and limited cash for down payment. A minimum 3% can be from a borrower's own funds or a gift. Minimum credit score needs to be a 620. Okay, credit history. Home Ready can also be a solution for home buyers who don't have a credit score because they have no credit history. They can substitute financial statements such as 12 consecutive months of on-time rental payments or other monthly payments that do not appear on credit reports, like utility bill payments. Debt to income ratio. The Home Ready and Home Possible programs can be approved with a debt to income ratio up to 50% with strong credit and other compensation factors such as extra savings and retirement funds for reserves. Freddie Mac manages the Home Possible mortgage program. Home Possible is similar to the Home Ready mortgage, but there's a key difference. Home Possible allows borrowers to include non-borrower income in their financial calculations. So income from another person or people living in the home can count towards the total monthly income, even if those individuals are not part of the mortgage loan. This often benefits homeowners caring for a family member living in the house who receives disability or Social Security, for example. Your credit score must be 620 minimum, and the down payment minimum is 3% down with added flexibility for the source of the down payment. All right. Home Possible guidelines now allow for the entire down payment to be made from sweat equity, which means you can contribute your handyman skills instead of cash toward the down payment. Debt to income ratio. Maximum DTI is 43% with exceptions to 50% depending on the strength of your income credit and whether you have extra funds in the bank, reserves. Okay, I always say to have 3 to 6 months reserves per monthly mortgage, okay, payment. Okay. So the key mortgage documents that you need are a signed purchase agreement with the seller, W-2s for all employment going back 2 years, pay stubs for the last 30 days, bank statements for the last 60 days, tax returns going back 2 years, proof of homeowner's insurance, 1099 forms if you are self-employed. Now, homeowner's insurance, if you are working with a mortgage banker, they're going to already explain that you need mortgage insurance if you're doing FHA, et cetera, et cetera. Otherwise, if you're going out getting it on your own, you just make sure you get it, make sure it's reasonable rate, and make sure the insurance policy is above the appraised value of the home, ladies and gentlemen. And then also make sure you have disaster insurance included, flood insurance included, because they may give you the minimum and then you'll turn around if there's a flood and find out, oh, flood insurance or disaster insurance is not included. Let's move on. You need documented dividends, stock earnings, and other sources of income if you plan on adding those. Proof of bonus income if you have that. Pension statements, Social Security documents, securities documents such as stocks, bonds, and life insurance policies, Social Security or disability income award letters if applicable. Now, some of these don't apply to some people. Some of them do. Just work with those that apply to you, ladies and gentlemen. Okay. To get approved from to get pre-approval letter from a lender, you need to provide this. Pre-approval from a lender is required in order to have real estate agents show you properties, et cetera, okay? The pre-approval will also give you the maximum amount that you should be looking for in the property, okay? So if your pre-approval is $200,000 and $200,000 is the max price point for the property that you are purchasing, okay? So in order to get pre-approved, you need your identification, including social security number. Okay, you need all pages of the 2 most recent consecutive months of bank statements, and you need employment verification consisting of either a month of pay stubs or W-2s going back 2 years, or tax returns if you're self-employed, ladies and gentlemen. All right, so told you all that was kind of quick. Wasn't as quick as I expected, but you know, that's a little extra step. All right, ladies and gentlemen. So hopefully you guys got a lot of information out of this episode. Sign up, like I say before, as always, sign up for those Ox Publishings, for those trade lines. Sign up for, you know, the school, the Real Estate Confidant School, $14.95 a month. Membership, I believe that's what it is, $14.95 right now. Go ahead and listen to my past podcasts and blogs, ladies and gentlemen, on iTunes under the Real Estate Confidant School. Go ahead and follow me on Instagram at the Real Estate Confidant, ladies and gentlemen. And remember, knowledge is power, but applied knowledge is a portfolio. I'll be talking to you soon.